Hello everyone, I am Vijay Gupta. This video is regarding 11th Amendment of UP-RERA regulation whereby promoters may face serious cash flow challenges. If you are a promoter, CFO, chartered accountant, banker or a real estate consultant dealing with projects in Uttar Pradesh, this amendment may significantly impact your project cash flows and withdrawal planning. UP-RERA has notified 11th Amendment in the regulation effective from 29th May 2026. At first glance, it appears to be a routine change in the forms and procedure. But in reality, it fundamentally changes how project costs are going to be recognized, how withdrawal limits are going to be calculated, and how project loans will be treated. Let us understand the key changes and their practical impact. The first and perhaps the most important change is the complete redrafting of the Chartered Accountant Certificate in Form REG3. This is a certificate on the basis of which promoters determine the amount which can be withdrawn from the RERA account. The revised format introduces several major changes. Let us start with the land cost, where the land cost is acquired through joint development agreement. The land cost will now be considered as higher of actual acquisition cost of the landowner or the circle rate prevailing on the date of RERA registration. Similarly, where land is inherited, gifted, or acquired through a will, the land cost will be considered only at the circle rate value. Now, this sounds simple, but the practical impact could be enormous. In many development agreements, the commercial value agreed between the promoter and the landowner is substantially higher than the prevailing circle rate. This happens because the circle rates are often outdated and do not reflect the market realities. It also happens because the landowners receive their consideration over an extended period linked to the project progress and bookings while assuming substantial project risks. However, under the revised framework, the promoter's withdrawal eligibility is restricted only the circle rate or the original acquisition cost, whichever is of the landowner. This creates a significant mismatch. The promoters may be contractually required to pay the landowner a much higher consideration, but RERA may permit withdrawals only to a lower land cost figure. This is likely to affect project cash flows and financial planning across numerous development projects. Now let us come to what is perhaps the most critical issue arising from the revised CA certificate format, the change in the formula for withdrawal of funds from the RERA separate account. What makes the issue particularly significant is that this change has been introduced through CA certificate format itself without any corresponding change in the Act, rules or regulation. Under the earlier formula, the amount eligible for withdrawal was total estimated cost multiplied by percentage of cost incurred. It means that a promoter could withdraw funds equal to actual costs incurred on the project. However, under the revised formula, the amount eligible for withdrawal is calculated as amount deposited in separate account, that is 70% of the collection plus loan disbursement multiplied by percentage of cost incurred. This results in a substantially lower withdrawal entitlement for most of the projects. Let us understand this with a simple example. Suppose a project is 30% complete. Under the revised formula, a promoter is permitted to withdraw only 30% of the amount credited in separate account, while the balance amount remains blocked until the project progress is achieved. In many cases, this withdrawal entitlement could be significantly lower than the actual cost incurred by the promoter. The only exception may be projects that are nearing completion, where the impact of the revised formula may be comparatively limited. This raises a serious concern. A fundamental change affecting funds withdrawal has effectively been introduced through a revised CA certificate format, despite there being no amendment to the statutory framework governing withdrawals. The practical implication could be far-reaching. The revised formula may substantially curtail the withdrawal capacity of the developers across projects at various stages of development, leading to liquidity constraint, disruption of construction schedule, and additional compliance challenge. The issue is likely to become particularly critical when the next round of CA certificate is to be issued in July 2026. Given its potential impact on the project execution and cash flow, the matter warrants urgent clarification and, in our view, reconsideration by the authority. Now let us come to what may become the most debated amendment, the treatment of the project loans. The revised regulation requires that entire amount of project-related loans, whether disbursed before or after RERA registration, must be deposited into the designated 70% account. At the same time, repayment of the principal amount of the project loans will be permissible only after receipt of the completion certificate or occupancy certificate. This raises a critical practical question. In most real estate projects, loan repayment commences much earlier and are serviced from the project revenues as collections start flowing in. If sale proceeds are required to be deposited into the RERA account, then how the principal repayments are not recognized until receipt of the OC or CC, and how will the promoters service their project debt obligation? This is likely to become one of the most closely watched implications of the amendment. Promoters, lenders, and finance team may need to revisit their financing structure and withdrawal strategy immediately. UP-RERA has also expanded the definition of amounts deemed to have been withdrawn from the project. This now includes amount withdrawn from the RERA projects, project receipts not deposited into the RERA account, loan amounts received but not deposited into the RERA account, and repayment of the project loan principal. This means that even indirect utilization of the project funds may now influence the project withdrawal calculation and compliance assessment. This amendment also revises Section Regulation 53 relating to project bank accounts and aligns with the Real Estate Project Bank Account Direction 2020 as amended from time to time. Next significant aspect is the revised framework is that the prescribed CA certificate is now required to be used and strictly as notified by UP-RERA. The certifying CA is required to specifically certify that no changes have been made in the prescribed format. In other words, the flexibility that was often exercised in the past by incorporating explanatory notes, qualification, or project-specific modifications are now prohibited. This requirement assumes greater significance in the light of UP-RERA's earlier directions, empowering the authorities to initiate action against the certifying professionals for non-compliance or incorrect certification. Such matter may be referred to the respective professional institute, including ICAI, or disciplinary proceeding, which could potentially result in professional penalties, suspension, or other adverse consequences. Accordingly, CA certifying the RERA withdrawals may now be required to exercise a significantly higher degree of diligence, documentation, and professional caution while exercising and while issuing certificates under the revised framework. The next change relates to the construction cost, which has a lesser impact. The plant and machinery, etc., used in the multiple projects, only the proportionate depreciation and proportionate hiring charges can be considered in the project. Another important aspect is about the GST. The long-awaited demand of the industry has been accepted by the RERA. 70% of the GST amount actually deposited with the GST authority, that is net of input tax credit, can be considered for the withdrawal calculation. Similarly, where refunds are made to the allottees, 70% of the refunded principal amount, excluding interest, compensation, penalties, will now be considered while calculating the withdrawal eligibility. Promoters should therefore review their existing bank account, operations, funds flow mechanism to ensure complete compliance. Finally, UP-RERA has also introduced significant compliance requirement for real estate agents. The agents must now maintain cash book, journals, ledger, customer register, etc. in Form REG 8 prescribed by RERA. These records must be preserved for at least 5 years. Agents are also required to file quarterly returns in Form REG 9 within 15 days from the end of the quarter. Failure to file these returns can result in a late fee of Rs 10,000 per quarter. Importantly, the first filing must contain details of all transactions facilitated since obtaining registration with UP-RERA. To conclude, this amendment is far more than a procedural update. It directly impacts project finance, land cost recognition, withdrawal eligibility, loan servicing, bank account operations, and even agent compliance obligation. Every promoter, finance team, chartered accountants, real estate agents, and professionals operating in UP should carefully review the amendment and evaluate its impact on ongoing or future projects. If your project is funded through loans, it involves a development agreement or relies on phased withdrawal from RERA account, immediate assessment and planning may be required. Hope you will find this analysis useful. For any questions on UPI RERA compliance, project finance, bank account operation, or withdrawal calculation, feel free to reach out. Thank you for watching. Disclaimer: this video is intended to provide a broad overview of the amendment. Stakeholders should refer to the official notification and applicable regulation for complete text, interpretation, and compliance requirement. Thank you very much.